Hello everybody, welcome to another episode of Erickson TV. Curtis here with Lauren. Hey Lauren.
Hey everybody.
Hey Lauren, since this year is going by very rapidly,
right.
We're getting close to the end of 2011, I thought it'd be interesting to talk about tax deductions and some potential expiring provisions that may make sense to take the sure thing, a sure deduction before this year end.
All right.
I thought we would contrast that with the uncertainty of financial planning. What are some of the, what are the dangers of financial planning for the future?
All right. Well, actually, I'm going to teach my class tonight, and it's going to be the Putting It All Together class for financial planning. So, I mean, one of the reasons why I teach the classes the way I do, I often talk about financial planning as it's almost like a back of the envelope calculation. You know, to tell people to not try to get too specific with financial planning, because the problem is that things change.
Right.
And you know, the markets for most people is the least uncertain over the long run of all of the different things that can happen. You know, how long are you going to live? Are you going to get sick or not? What's going to happen with your kids? All that other stuff. And of course, in financial planning, you know, you want to you want to think about things. You want your income after tax.
Right.
You know, you want a real income, not like a pre-tax income. And all that's good, except for the problem is that one of the many things that changes in the world is taxes change.
That's right.
And so that makes things difficult as well.
Right. So in tax planning, we are certain that there's law on the books that are definitely going to indicate things that are going to expire. So certain tax benefits or tax deductions are going to expire at the end of this 2011 year.
Right.
Unless, you know, by some act of miracle, Congress and our current president can
we can't seem to agree on much.
Agree based on that, that's
right.
fraught with uncertainty. So that's why I call this thing the sure thing, tax deduction. And the thing about tax planning is we never recommend to buy something to create a tax deduction.
Right.
It's always based on, if you're going to buy it anyway, if there's a way to make it a pre-tax deduction or to get a tax credit, then that makes sense. But so again, take this with a grain of salt. Everything we're talking about here is not to go out and do this, you know.
Right.
But if you're thinking about doing it anyway, maybe sometime next year or this year, then perhaps it makes sense to do it this year because of the tax benefit. Okay. So let's talk about let's talk about upgrading some of your you know, residential appliances. You know, things like water heaters and furnaces and things like that. One thing that's on the book that's definitely is going to expire on December 31 is the residential energy tax credit.
Oh, right,
okay?
yeah.
So basically, if you were going to do it anyway, you wanted to upgrade with this probably cold winter that's going to be happening.
Right.
You know, there's a tax credit of up to $500 available that's going to expire at the end of this year. Okay. Another one, and this affects clients that are here, especially in Washington State, is sales tax deduction. That's set to expire.
Really?
It is.
I didn't know that.
Yeah, that one's an interesting one because it's been on the books now for 3 or 4 years.
Right. And
we sort of get used to it as a law. But a little known fact that most people didn't know is that was set to expire a year ago, and it was passed in at the last second.
Right.
They've only increased it through the end of this December 31st, 2011. So there's one thing about, you know, making purchases that if you're going to make the purchases sometime, you know, relatively early next year, especially if it's like a vehicle, for a personal vehicle, or maybe house improvements, it makes sense to do, if you can do it, to do it before this year. Okay. Right. And if you did end up saying, I'm going to buy a car, and you finance it, let's say, you know, with financing or like that would still qualify as a sales tax deduction. So if you do it before this year, that makes sense. Okay. And then the last one I want to talk about for this year is, this is more for a business deduction if you're buying a vehicle for your business. Okay. And there's it's pretty well known that when you buy like you know, a fixed asset for your business, you can depreciate it. Right. And if you're making what's called a 179 election, you can write it off all in 1 year. Okay. But for vehicles, vehicles have strict limitations depending on what type of vehicle it is. Right. So for the general passenger vehicle, if you buy that for your business, that doesn't matter. You could buy it this year, you could buy it next year. The depreciation is going to be very similar. That's not really changing. But if you wanted to do the 179 deduction for let's say an SUV, a heavier vehicle, it would make sense to buy it this year versus next year, because you're limited to next year you're limited to a $25,000 one-time write-off for an SUV, but this year it's virtually unlimited because of this thing called bonus depreciation. And so you can buy a $50,000 SUV and write it all off this year, even if you bought it on December 31.
Interesting.
So that's the last thing I wanted to say about 2011 provisions. On our next episode, we're going to talk a little bit farther out in tax deductions for the sure thing, and we're going to talk about tax planning for 2012. All right, thank you very much for watching this episode, and we'll see you next time.
See you next time.
Bye now.